How do you calculate cap rate for unstabilized real estate income? Imagine you're eyeing a property that's not yet fully rented or operational. You want to know if it's a good investment, but how do you figure out its potential return? That's where cap rate calculation for unstabilized income comes into play. The cap rate, or capitalization rate, helps investors understand the return on a property without considering financing. For unstabilized properties, it's a bit different because the income isn't at its highest or most stable level yet. Instead, you use the current or projected net operating income, which might be lower because of vacancies or ongoing lease-up periods. To start, you need to find the current or expected net operating income. First, calculate the effective gross income by subtracting vacancy and collection losses from the potential gross income. For example, if the potential gross income is $100,000 and you expect a 10% vacancy rate, the effective gross income would be $90,000. Next, subtract all operating expenses like property management, maintenance, taxes, insurance, and utilities. Do not subtract mortgage payments because cap rate looks at unlevered returns, meaning it ignores financing. Once you have the net operating income, you need the current market value or the purchase price of the property. If you're buying a new development, include land costs, construction expenses, and development fees in your valuation. For existing properties, use the current market value based on recent appraisals or comparable sales. Now divide the net operating income by the market value or purchase price. For example, if the projected net operating income is $50,000 and the property's value is $500,000, the cap rate is 10%. This means you're earning 10% of your investment annually based on current income levels. It's important to remember that unstabilized properties tend to have higher cap rates because income is less predictable and the risk is greater. Investors often adjust the cap rate by considering expected income growth as the property stabilizes. If you expect income to grow by 2% annually, you might factor that into your risk assessment. In real estate markets, especially in neighborhoods popular among Asian American investors, understanding this calculation helps you gauge whether the property's current income justifies the investment. It's wise to combine this with other metrics like cash-on-cash return or internal rate of return to get a full picture. Always analyze local market trends, vacancy rates, and income growth potential before making a decision. Consulting with brokers or advisors familiar with the community can help refine your estimates of stabilization timelines and income projections. In summary, calculating the cap rate for unstabilized real estate involves taking the current or expected net operating income and dividing it by the property's purchase price or market value. This gives you a snapshot of the potential return and helps you weigh the risks before the property reaches full operational stability.